let's focus back to the macros and on the debt side. Sanjay Shah, the Senior Vice President and Fund Manager Fixed Income of HSBC AMC India, now joins in. Hi Sanjay, good afternoon, and it's a pleasure having you, join us on CNBC TV 18. We've been talking about how flows have been extremely strong, both on the equity as well as on the debt side. So first, if you could just put in number, how the flows have panned out, say perhaps so far in this year from the FIs as well as from the DIIs into the debt market, and if you could break it out where it's come.
Yeah, on the FII front, basically we have seen a substantial about 6 billion kind of flows this year on the fixed income side. If you compare this with about 10 billion outflow that we had seen last year from the fixed income side, this is a substantial flow in the first 3 months of the year. A lot of these FII flows have gone into treasury bills, which is a small short-dated instruments. And these are more of carry trade, so to say. But also incrementally we are seeing FII flows coming into duration products. We also have HSBC global product which is advised from here, India Fixed Income, and we are seeing good inflows in that fund as well.
Okay. Sanjay, hi, thanks very much for joining in. We've received a significant amount in terms of flows. For example, around 15,000 crores in Feb in debt. We've received 12,356 crores in January itself, and on a March month-to-date basis, it's around 8,500 crores. And this is after 6 months of continuous outflows that we saw from May up to November 2013. Would you be worried about the susceptibility of outflows that we would see again, possibly because of maybe QE being accelerated or maybe a global event which is unanticipated?
Yeah, so when the flows come in, necessarily they would want to go out at some point of time. And in fixed income market, flows do come in and go out with without substantial notice. So that remains an additional risk that we are building up right now.
So what is,
in terms of FX as well as,
So what is the risk that you're building up? Could you just explain to us what is that risk and how would you even mitigate it?
So as of now, as we said, there are substantial flows that are coming into the fixed income market, and these flows typically reverse when the forward rates start to go up and there is that carry trade actually closes out. So these flows may want to go out at some point of time. So these basically would create a risk for the foreign currency again, if as you said the taper were to be accelerated and so on. So that risk actually builds up. Also, the Indian government and Indian Central Bank has created this foreign exchange reserves which will be able to defend that. But to a large extent, the outflow and the funds reversing remains a risk to the domestic investors as well and the domestic interest rates as well.
Fair enough, Sanjay. But what is driving such strong, flows, debt flows into the Indian market? And according to you, while there are always risks, to these flows, do you think it can sustain?
So what is driving the current situation are twofold things. One is the measures that were taken by RBI, and especially after a new governor came in from September. That has instilled a lot of confidence in the foreign investors to come in the domestic markets, in the Indian markets. The measures which were related to FCNR, which were stabilizing the currency and so on, those have instilled a lot of confidence. In the month of January, when all the emerging markets were getting pressurized in terms of foreign currency, Indian market did sustain in terms of foreign currency. That has instilled some more confidence. So all these factors are coming together to give FIs parking space here, where they will kind of earn that carry, but at the same time the foreign currency is not that volatile, currency is actually strengthening as of now, and so on. So these factors have given confidence to the investors. Over a period, if these factors were to weaken, so say foreign currency for example start to weaken, and there were other factors like the global factors which are against Indian currency, then there may be the outflows that would start to happen.
What is your what are you recommending to clients in terms of duration on fixed income now?
As of now, we are recommending ultra short-term funds and short-term funds as investment opportunity. Also, some allocation should also go to duration funds as we are closer to the peak of the rate cycle. In fact, what we recommend to investors is that one should look at allocation in their own funds rather than looking at any following any particular fund which is flavor of the month and so on. Allocating according to their own needs will benefit better returns than actually going for flavor of the month kind of funds. So we actually recommend allocation to equity, fixed income, short-term funds and so on according to the necessity of the portfolio itself or of the investor itself rather than going with one particular fund at a time.
Sanjay, fixed maturity plans or FMPs have picked up in the last 2 months. This is after a lull that it saw, in the prior period. Can it sustain, and is that one of the key recommendations for retail investors to park their money?
Yeah, FMPs actually are a factor which always picks up in the month of March. When banks are willing to issue deposits and CDs at higher rates, FMPs typically pick up, and clients do lock in for 1 year, 2 year, depending on their time horizon. So this is a phenomena which will continue till end of March, and in April again we would go back to the normal open-ended funds and so on. So this is not going to be a sustainable phenomena, at least for the next couple of quarters. Again, they will start to pick up from September to March next year.
Is HSBC factoring in maybe FII outflow from the debt market, post-elections, or once the election outcome is known and maybe it does not favor the equity markets? Would you then assume that there could be debt market outflows as well?
Yeah, so we are as of now taking into account a couple of risk factors. One of them is election outcome. Other is obviously a monsoon and the weather related factors. So if these two factors are not very conducive and they are not supporting the equity markets as well as to some extent fixed income markets, then there can be outflows, and which will have to deal with whenever they happen. As of now, we are thinking that the probability of outflows post-election is not that substantial right now.
And what is your expectation on the range for the 10-year?
As of now, we are expecting 10-year to range between 870 to 9%. We are at about 878 currently, so we are very close to the 870 levels. So we are not expecting substantial rally from here. We would expect it to be range bound.
And what
major factor in this is from the next week onwards, there will be supply starting for government securities, so that will determine how the range plays out.
Okay. All right, Sanjay, thanks very much for joining in. So that's the view coming in from the fixed income space from HSBC at this point in time. They expect the 10-year range to be anywhere between 8.7 to around 9%. It's currently trading at around 8.77%. For the